All right, good morning, everyone, and welcome to our continuing lecture on consolidated statements, financial statements. We've so far gone through the consolidated statement of financial position. Here today, we want to look at how the consolidated statement of profit and loss is dealt with. I'm going to move straight. There is not much to actually to be done here. You have it the easy way here. So I'm going to split my board into two and show you some things straight away, how you deal with it in your examination. So normally, you will have in the question a P&L that is given to you and some footnote for which you are going to do some adjustments and adjust your consolidated statement of financial position. But you see that, let me try as much as possible to divide this into three. So I would love to capture everything here. Okay. All right, so that is that. Now, normally, this is how the P&L that has been given to you, which you are developing into a consolidated statement of profit and loss, looks like. So you will have, so let's say consol P&L. So the group name, all right, and you have your currency. Now, normally, this is how P&L looks like. You have revenue, then you have to be less in what? Cost of sales, right? According to IS1. Whatever you get, you are going to obtain your gross profit. Okay, then you are lessing things like administrative expense. Then you are lessing things like selling and distribution. Okay, so if there is research comes in, you less all these things. Now, when you finish, what you get here is what we call operating profit or loss. After this, if you have any investment income, it comes, right? Then you have any interest or finance costs, you deduct, right? You add here, you deduct here. Then you get what? Profit before tax. After lessing taxation, you now get what? Profit after tax. So normally this is where you end, right? Okay, so this is the same thing we are going to look at, all right? That's the same thing we are going to look at. Now, if you are presented any question that asks you to prepare P&L, how then are you going to approach it? There are 8 adjustments that may come your way to influence all these things. 8 of them, like the way we did in the consol statement of financial position. Here too, there are 8 that we are going to consider, okay? But you still have to do your workings, okay? The workings that we did in statement of financial position, you still have to do some of them here, not all of them, some of them here. All right, so that is what I'm going to bring your attention to. Now, what I'm going to do is to use this place for my workings. So workings 1, we all know is what? Group structure. But I'm not going to repeat some of them because you already have them. So the group structure is simple. That is where you draw your graph, all right? That the same thing you do under the consolidated statement of financial position. Now, then you also do your workings too. Fair value of net assets of subs at acquisition. You know, we had 3. We had at acquisition, at reporting, and we had post-acquisition. I'm not going to do all of those things again. But here, what I want to draw your attention to are some things, because, you know, you bring in your figures, whatever figures that you have, from the way you did the SOFP. Okay, so if the question calls out for you to go through that same process, especially if you are preparing console P&L and at the same time console balance sheet, you know you need to go through even all of them, all right? So that is it. That is what you have here. Now, then step 3, what do? We do goodwill. Now, the reason why I brought this is that most of the time you might not need these 2 portions. All you need is this 1 portion. Because if the question tells you, for instance, that goodwill impairment, which is a P&L item, is so and so percentage, all right, of your goodwill, then it means that you need to calculate your goodwill. You get it? That is why we are doing this workings. And so to find the goodwill and then later strike the percentage on the goodwill to get our impairment, all right? But if the impairment is given to you straight away, you don't need to go through this workings, all right? But I mean, we know how our exams are, and sometimes it comes through the difficult way. So instead of giving us the impairment figure straight away, they will tell us that it is a percentage on the goodwill. And most of the time, even in consolidated P&L, you may be asked to do goodwill itself before, as a part of the question, before you do the consolidated P&L. So it becomes very, very important. Now, if you are to go on to calculate goodwill, we all need that. You will need this. You will need this part. Remember, purchase consideration, NCI, fair value of net assets, all right? And this is the fair value of the net asset at acquisition. So you will need this. That is why you are going through these workings too, all right? That is exactly the reason why you are going to do that. So, I mean, so especially when goodwill impairment is expressed as a percentage. Okay, so that is how you will have to calculate your goodwill. And if you are going to calculate your goodwill, you need all these things here. You need, you remember, stated capital, the reserves, all right? If there is the reserves, we have share premium, you may have retained earnings, revaluation surpluses, I mean, PAPs, goodwill write-off, all those things, all right? Fair value adjustments and all those things. So you need all of them here. Uniform accounting policy adjustment, everything, you will need them here, all right? Now, at the end of the day, when we get this profit, we are going to split it. We are going to attribute it or split it in between the CI and the NCI. All right, so that is that. We are going to split it. And here, it is advised that you always do your NCI percentage first. And how are you going to get your NCI? You don't just take the percentage and strike it here. No, you don't just do that. There's a whole workings for that, and that is what I want to introduce to as workings number 4. All right, workings number 4. Now that one too is still the NCI, just as we have in the consolidated statement of financial position. So here too is still NCI. What we need here is the profit sharing, okay? The profit sharing. Now, we will need the profit for the year for the subsidiary. Okay, the subsidiary, profit for the year for subsidiary. And here you have to be careful. There are some things. So taking note of what media acquisitions. Okay, you have to prorate it if it is a media acquisition. And what you get, you present here. All right, so that is that. And you will bring everything that is surrounding NCI, everything that you've known surrounding NCI. Now, remember, what are the things? We are going to see them here. So you have what? Depreciation, the one that comes here, excess depreciation. You see those things that we have here. So we are talking about this column. All right. So depreciation, that is the fair value adjustment depreciation. Okay. You have to take it off. All right. So that's that. You remember PAPs. If S sells to P, the PAP inventory. Do you remember that? The PAP inventory, you have to also take it off like we did. All right. You remember the PAPs PPE, that one too, if S sells to P, PAP PPE, see, is the same here. But if there is PAP PPE, PPE PAP, and it is the parent that sells to the subsidiary. Remember what happened? There is a positive. Remember that from what we did. All right. So we're taking care of our PAP. What then do we need to subtract? Remember goodwill impairment, NCI share. NCI share. NCI share of goodwill impairment has to come here. We take it off. All right. So that is what you do. And these things normally come when the fair value method is used. Now, when you add everything up, what you get is what we call what? The adjusted profit. The adjusted profit. So it is how, this is where you will have to source your NCI share of the profit from. Don't forget, that is where you will source it from. Okay, that is where you have to source it. So you don't have to just strike a percentage, take the the profits after tax as you see here and just strike a percentage. It is not done like that. All right, it is not done like that. But you need to go through and work your NCI. Okay, once you work your NCI, then it is there that you can obtain. Okay, it is there that you can obtain your adjusted profit and strike your NCI percentage on it. All right, the NCI percentage on this. Okay, then you get what? Because the whole idea is that you are actually doing a profit or loss for the NCI. All right, and you know that the NCI is the part that you don't control. Don't forget. All right, so if you take the part that is what we are working out, then the part that we don't control is actually for someone else. That is the NCI. It's the part that we don't control. We want in this P&L to find out how much the the shareholders of the controlling people can obtain. All right. So this workings is done for the subsidiary, and you could see it's for the subsidiary. By the time you strike our percentage, if say 30% is the NCI, we will get it out of this figure. All right. And that is what you slot in here. Whatever, when you strike your NCI percentage on the figure, whatever you get is what you slot here. Okay, then the difference, which is the balancing figure, between this and this is what will give you the profit attributable to what? Your CI shareholder. So this balances with this. But the difference between this and this will give us what? This. All right, so note that. So that is the key. All right, that is the key. So there is nothing that difficult around this place. All right, that is all. That is all. Now, what you need to go through and do is to work out the adjustment that may come away, the tricks that will be put into the exams that we need to deal with. All right. So straight away, let's look at those 8 adjustments. Number 1 is intra-group trading. Intra-group trading. Okay, but let me actually start from a media acquisition. Okay, so let me start with media acquisition. Okay, so that is that. If the subsidiary was acquired media, then what we will know is that, remember we said that the profit or loss is assumed to be evenly accruing, all right? And so therefore, here, the constant thing is the parent figures. You will have to bring in the parent figures. Nothing changes about that. Any investment income, the parent figures. Tax, the parent figures, all right? You need to bring in all the parent figures. And remember, you need to also bring in the subsidiaries figures. Now, this is where I am interested in. Subsidiaries figures, and this is P&L, all right? These are not cumulative figures, they are P&L. All right, so that is that. That is that. You add them. If it is acquired full year, you don't have a problem. But if it is mid-year, then it means that all the subs figures must be apportioned. All the subsidiary figures must be apportioned. All right. So, for example, if acquisition is 6 months into the year, then it means that all subs figures must be apportioned. What do I mean by that? You are going to multiply all the subs figures by 6/12. That is what will happen. Now, you don't just punch on your calculator. Remember, I've said that, and put the figures there. No. What you are going to do is to take the subsidiary figure and do 6/12. Yeah, 6/12. Okay, yeah, multiply by what? 6/12, because the acquisition was mid-year. Okay, it was mid-year. So that's how you show it. 6/12. What? Multiply by 6/12. Multiply by what? 6/12. So all of them, all of the figures have to be multiplied by what? 6/12. This one to what? The tax to is what? 6/12. All the figures. All right. So that is what you do. So you have to check. If it is 9 months, it will be 9/12, like that. All right. That is how it flows. All right. Take note of that. So that is the first trick. And mind you, per experience, there is no way they will ask you to prepare P&L and give you a full year acquisition. No, it will always be somewhere within the month. All right. So be very, very careful. Okay. Then we have trick number 2 that they would want to bring into your exam. That one is the intra-group trading. Do you remember when we were doing the balance sheet where the intra-group trading gives rise to receivables and payables? Receivables and payables, and we said you have to cancel it off. All right. Here, so the sales amount, our focus is the sales amount, not the receivable amount, not the payable amount. The product, how much of the inventory that was sold is what we are interested in. Okay, that is what we are interested in. And remember, when you had intra transit items, remember how we used to do it? Treat it as if the person who is supposed to receive received it and all those stuff. But here, our focus is on the sales, the selling, the sales amount. Okay, and also let's say on the reverse, the purchase amount. How much of the inventory was sold here? Okay, and we say that these things that were sold is what gives rise to the receivables and the payables. But our focus is on the selling amount. So, or the purchase amount. The intra-group trading does not even have to exist. All right. I mean, it is kind of a way that you cannot actually sell between yourself and make profit out of it. So the sales amount is what we are focusing on. And what happens is that we have to treat it as if the sales never existed. Why? Because while this person is recording sales because he has sold, the other person is recording what? Cost of sales. Are you getting it? And it comes together and it zeros. Okay. So what are you going to do in this case? What you need to do if there is intra-group trading is to take away that sales. All right. So you have to take off intra-group sales. All right. You have to take it off. The same way when you are taking it off, this person also has to take his part of out of the purchases. And so you have to also same amount here, less it here, intra-group what? Sales. So you have to less it also here. All right. Easy peasy. So, I mean, you don't have to worry yourself about receivable cancellation when it is a P&L. You just have to take it off here. All right. So that is that. Okay. So that is what you do. Trick number 3. Most of the time, when there are these sales, you may have to compute PAPs. Okay. PAPs. That is it. The PAPs, when the P sells to the S or whether the S sells to the P, is still PAP. The only thing is that when the S sells to the P, it comes here too. All right. But as with regard to the P&L, as we are seeing it here, whether P sells to S, sells to P, there is still a provision for unrealized profit. And we need to also what? Take it off. How do you take it off? You have to add the PAPs to the cost of sale. Add PAPs to cost of sale because you are removing the profit out of the sale element. All right. So here, what you do is that you have to add what? PAPs. Okay. Add PAPs. That's all. Nothing difficult. All right. That is it. There's nothing difficult here. Trick number 4. Trick number 4. What happens is that apart from PAPs, normally the things that you see in workings too, apart from PAPs, what do you see again? Fair value adjustment. So the fair value adjustment depreciation, that is most of the time seen here in the workings too, in these workings. All right, it's also a depreciation. And how do we treat the depreciation? Depending on the question, okay? Depending on the question. If the question tells you to add it to administration, add it you have to add to administration. If the person's question remains silent, you add it to cost of sale. If it directs you to cost of sale, you also put it into cost of sale. So what are we talking about here? Here, we need to add what? Fair value adjustment, depreciation. All right, easy peasy, we are done. All right, that's it. Now, the fifth trick is that when you are being asked to, prepare goodwill, calculate goodwill, you know that what you get in the goodwill that will affect this part is what? Goodwill impairment. Goodwill impairment. And don't forget, this is the group. There is no split. So all the goodwill impairment also comes here. What do we do with goodwill impairment? Add it to your cost of sale. So here you have goodwill impairment. Okay, so when you add everything up now, you can slot in your figure. Here you have 3 items, you put it here. All right. So in a typical question, as you are seeing, you will have to bring in the parents, prorata the subsidiary, okay, take off intra-group sale from the sale and the revenue and the cost of sale, add PAPs because you are deducting from sales. Fair value adjustment is a depreciation. We all know depreciation is an expense. Then goodwill impairment is just another name for depreciation, okay? The only thing is that we don't depreciate intangibles. We amortize them or we test for impairment, okay? So that is that. That's all. You are good to go. That's fine. The next trick that may come in our question is when there is interest on loan. Okay, when there is interest on loan, we said that you cannot give money to yourself and be benefiting in the form of an interest on loan. So that one too has to be what? Taken off. How do you take it off? There is finance cost here. So you take it off. Interest on loan. Easy peasy. You are done. Okay? It's not difficult. You are done. Trick 7 is when they bring dividend in the question. Now, remember in this place, financial reporting, we are not meant to be preparing consolidated statement of changes in owner's equity. Other than that, if the parent actually pays the subsidiary dividend, it has to be shown in the statement of changes in owner's equity. All right, but here it's outside our scope. If you are doing corporate reporting, then you have to also report it in the statement of changes in owner's equity. All right, but aside that, it is dividend, and dividend is what? Investment that you made somewhere and you are getting what? Interest. So, whether it's subsidiary, whether it's associate, the concept is the same, right? Intra-group with the associate, you will less it and less it. The thing is the same, all right? The thing is the same. Media acquisition, the same, okay? But it's just that we don't add associates things like that, okay? Because they are not our subsidiary. We don't prorata them, okay? So what we'll be interested in over there is probably what? PAPs, okay? PAPs. All right. So those are the things that if there is a loan there to you consider it, all those things. All right. The associates, you don't actually deal with interest on loan side because if you have to take an interest because it's small or less like an investment, all right, or investment in there. So we don't need to actually bother ourselves with the interest on loan and all those stuff with the associate. We will deal with it in questions when we are solving that. If there is any, we will watch it out. But most of the time, what you catch up from there is the PAPs, all right, is the PAPs. All right, so take note. Let's see how when we get to associate, we will deal with that aspect. So let's not even bother ourselves. Our focus here is on the subsidiary. So let me scratch off this associate. You will look at some things. There are some peculiar things over there we may look at. Hopefully tomorrow lectures. Now, let's come back to our dividend concept. If there is any dividend, what do? You cannot benefit from yourself. You remember? It's a dividend. And so that is what we say in that case, deduct it from what? Investment income. It's the same way of the interest on loan, but it's just what? A classification. So here you will take off what? Dividend. Dividend. Easy peasy. That is it. So you get what you have here. All right. That's all. The last trick that may affect your P&L is what we call the unwinding finance cost. So the yearly unwinding, right, is a finance cost which you need to add. That is that finance cost. So you add them up. This is where you get. All right. So that is that. So we can now close our brackets. These bits, you are good to go. Tax. That's it. You are good to go. All right. You get your profit. Remember, you work this out from your NCI workings for, as you see it here. Okay. I mean, easy peasy. You are done. I don't think Consol P&L is that difficult. You just have to do it and finish it. Okay. That's it. Let me just give you a minute to just observe what is on the board. We are going to solve a question. Then we are through with Consol P&L. All right. In a typical question where you are doing this thing with a P&L, your workings for here with the SOFP, your workings for here, you might not even need to bother yourself. Remember the split that we do here? All right. So fair value, the post acquisition, the split that you do here, the NCI share, we just drop it. That's it. All right. That's it. Because not all questions may allow you to go through all these things. All right. So that is that. That is that. That said, let's just take an illustration and deal with it. All right. Let's take an illustration and work it out. All right. So what do we have here? Let's take this illustration. Okay. So this is what we have here, illustration 4. What do we do when we see a question? Go back and read your requirements. The requirement says that we are supposed to prepare consolidated statement of profit and loss for the year ended when? 31st March. That is the year end. So what do we need to go and do? Go back and start reading our question. All right. Now the purchase is what? 70% of Steven. Okay, that's fine. Then what do we have? July 2016. The thing was when? March 2017. So what do? Let's count from July 16 to July. Actually, if something is ending at 31st March, then it will start where? 1st April. So it means that April, May, June is off. We're starting from July, then it means what? It's 9 months. Hey, we got you. So that is that. So it means that all these figures, all these figures must go through what? 9 months apportionment. Hey, we found you. found you. I think there is a repetition here, which is supposed to be profit, operating profit, right? All right, but what we know from this on this date is to apportion this all over 9 months. All right. So, I mean, we don't have to waste time. If you have a console question which is demanding from you a P&L, you don't waste time. Just go straight and set up your solution template. Don't waste time at all. So leave some 1 or 2 pages for workings and move straight. Okay, so if this is our answer booklet, what I mean is that let's just move straight. Leave some 2 page here and come. So you bring in the group name. What was the name of the group? I think we have what? Paul. So Paul group. Consolidated what? Statement of profit or loss. Please write the full thing, okay? For the year ended 31st March 2017. And the template for P&L is always the same. So why not? We have revenue, we have cost of sales. You end up having our gross profit. We have what? Administrative expense, selling and distribution. Okay, we will end up with what? Our operating profit. We add investment income. Just slot them, okay? Whether it's in there or not. If it's not there, just put in 0 over there. So just for time, finance costs. All right, you will now get what? Profit before tax. Then tax, then profit after tax. We get our final answer. We come and do the sharing. So you don't need to waste time, okay? Don't waste time. All right, so we all know that group structure, workings 1, group structure. Don't lose this mark. There is Paul, all right? And there is what? Stephen. The acquisition is 9 months. And there is what? 70% acquisition. Okay. Let's see if there is a call for workings 2. I mean, it depends on the question. So let's come here to the question. All right, so we've seen also we'll be picking every figure here for the parent. Nothing will we change over there. You'll be seeing everything over there. Okay. So remember, and you see here clearly that because it is not combined with a SOFP, we may not have retained earnings, stated capital to do that kind of workings too that we do. So it means that what we need to do is straight away move on to if there is, then if that is the case, then it means that if we are not doing anything workings too, then it means goodwill should actually be given to us such that the impairment is also given to us. Hallelujah. So when goodwill is given to you, you don't need to do the normal workings too. So your workings two therefore becomes what? Your workings 4 now becomes your workings 2. It means that workings 2 and workings 3, which is fair value of net asset at acquisition and goodwill determination, is given to us. Is that not easy? It's easy. All right. So like we see here, clearly can see in this note. So these are the notes that we are going to deal with. First and foremost, we know that we are going to prorata the figures, right? Goodwill arose on acquisition 800. The fair value method was used and the goodwill is 10%. I mean, they've given us goodwill. So what do you need to do? Just strike 10%. It's as simple as that. All right. As simple as that. All that we need to do is that we need to factor the goodwill in our NCI computation, the impairment. Okay, we need to factor this impairment, the full impairment in our NCI computation. All right, so note that the full impairment, please, the full impairment. All right, in our NCI computation. That's all. All right. Then what else do we do again? On July 26th, what happens? July 26, 2006, there was a transfer of item of plant, and at the same time, who transferred? S transferred. So it means that we are good to go. The only thing that we need to do is to what? Calculate the PAP on this transfer. That's all. The PAP on the transfer. That's it. Is it difficult? No, I don't think so. So the transfer item, the remaining life is 10 years. Depreciation is charged to cost of sales, you know, all right? All right, so this one is not actually PAP transfer. It says that Stephen transfer item that had fair value of 5,000 in excess. What is that? Fair value adjustment. Fair value adjustment. So what do we need to do? We just have to strike it. And remember, once you divide this thing over 10 years, you are getting depreciation per annum. But don't forget, it was a mid-year, 9/12. All right, don't forget. During the post, Stephen sold goods. Okay, this is PAP inventory, 44,000. And don't forget, these goods in itself should be taken away from what? Our sales and what? Our cost of sales. And they said that 500 out of the amount was still included in the closing stock. And Stephen earns what? A margin. A margin. All right, so that is that. Do we need to convert to markup or something? No, because what? Stephen sold. And Stephen earns what? The margin. Don't stress yourself. The person who sold is who the percentage is attributed to here. There is no change. All right. That is that. Stephen paid dividend. What do we do? All that we need to do is to take the dividend of our investment income. I don't think it's that difficult. All right. So that's all. That's all. What do we need to do? We need to thank God our workings 2, workings 3 has been taken care of for us. So we now need to move on to workings 4. So in this case, that becomes what? Our workings 2. What is that? The NCI. Okay, the NCI. All right. So what do we need to do? We need to get the subs profit. All right. And don't forget, it has to be prorated. All right. So what is the subs profit? But before then, we all know that this whole thing is what? 9 months. So we need to take off it. So what is the profit of the subsidiary? Where are you? Let's go to the 1,100. All right, here you are. Bam, 1,100. So we pick you and we move straight. Straight, 1,100. When we do 9% of 1,100, what are we getting? 820. All right. Remember the things that we had to take off. There were things like PAPs. Do you remember? Fair value adjustment, depreciation. Do you remember? Impairments. All right. So what are those things? What are the PAPs? The PAPs, we saw that it was what? 35% of the inventory that is still in stock. How much was the inventory that was still in stock? If you check the question well, as I did, it was what? 500. But first of all, don't forget these things. We will have to pick the figures. So I will use those ones that are inside what you have already. Okay, I'll create it over there. But don't forget, there was intra-group trading. So remember, it was mid-year, 9 months. Okay, there is intra-group trading. which we need to take off. How much was that? 4,400. You take it off from your sales, you take it off from your cost of sales. So that is that. Then you've worked your PAP. What do you get? 175. Okay, so that is that. We are less than what? 175. Okay. Goodwill impairment, they said it was what? If I saw it correctly, it was 10%, right? 10% of the goodwill, which was 800. How much is that? 80. Yeah, lesson. Fair value adjustment. Don't forget, we had 5,000 for 10 years multiplied by 9/12. Okay, don't forget it. And that one too will be how much? 375. If you take everything off, how much are you earning here? 100 and what? 95. Don't forget, then we now bring in our NCI, which is what? 30%. We multiply 30% of this 195. So how much we have here? 58. So straight up, you know that your NCI share from your workings 2 will be what? 58. Okay. Easy peasy. The rest of the things, let's just go and start adding them up. Start adding everything up. Don't forget there was dividend. You will have to deduct the dividend from the investment income. It's a straightforward start. Okay. Straightforward. That is that. So how, and I need you to keep these pictures. So how are we going to now deal with the question? Remember dividends. All right, you have to take it off. That's all. So let's just go back. So it's a repetition. This one, you don't waste time. It's just a repetition. It's just a repetition. If I have the group here, and I'm going to be adding this. So let's also slot here. My revenue will be how much? I'm going to pick this 31,200 plus into bracket 10,400 multiplied by what? 9/12. That is what we have. Okay. And what? The intra-group sales, 4,400. It's that simple. You just have to slot in here. All right. Note that the cost of sales that is here. How are we going to do it? 17,800. All right, plus into bracket 5,600, 9/12. All right, less the 4,400. But don't forget, we have things like what? The PAP, which we worked. How much was the PAP? You have to bring it in here. How much was our PAP? Can somebody remind me? Yes. Yes. All right. So we had PAP and we had what? Impairment also. Don't forget. We also had impairment. But the impairment, where were we asked to put it? The one thing about using this board is that when I go and I come, it vanishes. So what I'm going to do is that I'm going to go for the last time and I want you to see everything, all right, and put them down. All right. So you see here, PAP is 175, fair value adjustment depreciation. This one, cost of sales. This one to cost of sales. Where did the question ask us to put the impairment? I remember the others we were told. So let's go downstairs. Impairment is charged to where? Operating expenses. All right. So, okay, that's fine. So the operating expenses is always the combination of what? The admin and the distribution. I think so. If they gave it to us at once. Okay, so we have them now. We have our depreciation. This is the 4,400. That is that. Anything downstairs, we need to take a look. The dividends, 500. All right, so that is that. So now, when we go and come back, we are putting everything into it. All right. So this is what you need to view, and these are your setup. So here, the 2 were giving us what? Operating expenses. Dividend was 500, which we will take off. All right, this one, they told us to go to where? Operating expenses. So we need to add it up to the operating expenses. All right, so that is that. So now let's go and finish it off. And don't forget, we had 58 here. All right, for the share. Don't forget. All right. So now let's go back and finish it up. So what do we do here? Our revenue, we extend it. It will be what? 31,200 plus into bracket 9/12 multiplied by 10,400. All right. Then we take off what? The intra-group. Okay. That one will give us what? 34,600. The same thing we do here. Cost of sales 17,800 plus into bracket 9/12 multiplied by 5,600. Okay, we less our 4,400 plus what? Depreciation, which they said it should come to cost of sale. And our PAPs, all right, PAP was what? 175. This is PAP. And again, we need to add what? Our 375, which is what? Depreciation. All right, when we add everything up, where do we get to? 18,150. Now we can get our gross profits, which is what? 18,150. So this one will be what? 16,450. That is our gross profit. All right. Then we have what? Operating expense. The same thing. All right. What do we do? 8,500 plus into bracket 9/12 multiplied by what? 3,200 plus what? The impairment we were asked to bring here from workings 2. All these things were from workings 2. You need to show them as such. So what do we have? 10,980. So what is our operating profit? So we have here 5,470. So that is it, operating profit. All right. Investment income. There is none here. Normally, we don't have such. All right. So 2,000 plus what? 0 minus the 500. Was it 500? Let's look at it. I think we had something like 500. Told us that Steven paid, yes, so 500. Oh, there's something I've not looked at. Yeah, it's 500. Oh, I see it. I see it. If Steven paid dividends of 500, there's a trick there we need to check. They paid dividends of 500. Question was not specific that they paid it. I think it's something that we need to also check. If Steven paid dividends of 500, and the question never tells you that the entire money is for the parents, just be careful. All right, just be careful. If the question remains silent on it, then how do we know that all the 500 is for Steven, the poor? So if it remains silent, please, you have to take off the 500, and you have to, it's 70% that we have. So they said they pay dividend of 500. Open. It's so open. All right. If that is the case, match the one that is coming here, apportion it to the percentage that they have, they own inside. All right. So please be careful. Be very, very careful. I think I should have brought it to your attention when we were doing the tricks. All right. So be careful. If they remain silent on it, strike the CI share for me. All right. Because when I got there, I feel like I should have said something about it. Now I remembered and I've said it. All right. So how much do you get from this? What is the figure? Calculator. Okay. So I have 350 for this, and so I'll have 1,650 for this. So please be careful about the dividend. All right, it's done. It's set. Let's move on. We have what? Profit before tax to be how much? I'm having 7,120, and I have my tax 2,100 plus into bracket 9/12, 500. All right, so I have here 2,475. So my profit is what? 4,645. Profit after tax. So how do I split this? Don't forget, we work the NCI in our workings too. So we say that attribution, NCI is the last year, but it is the one that we do first. So I have 58. So owners of parents will now be receiving what? The 4,645 minus the 58, which gives me 4,5,7,87. All right. So this one to balance up, coming 4,645. That is all. Okay. So it doesn't matter the question. So far as it is between parent and subsidiary, it's so simple. This is what you go through. All the tricks has been given to you and you can manage yourself. So that's it. That's for every question concerning console P&L. So now you are good with console balance sheet or statement of profit, well, statement of financial position. You are also good with console P&L. You've already passed your exam. All right, that's great. Okay, so I'll see you tomorrow where we tackle when we have associates inside the question. I think from now, you are beginning to have the feel of passing the exams. All right, see you tomorrow. Bye-bye.